A strange thing is happening in the world right now. Millions of people wake up, go to work, save money, and without realizing it, they're all betting on the same 500 companies. They don't meet the CEOs. They don't read the financial statements. Most couldn't even name 50 of those companies. And yet, their future depends on them. This is the story of the S&P 500 and why almost everyone ends up using it, whether they know it or not. Let's start with something uncomfortable. If you tried to pick individual stocks, just you, your phone, and your instincts, you would probably lose to the market. Not because you're not smart, but because the system isn't built for you to win that way. Over the last few decades, professionals with entire teams, analysts, data scientists, insider access to management have struggled to consistently beat a very simple thing: an index. No opinions, no predictions, just a list. That list is the S&P 500, and it quietly controls trillions of dollars. Here's why this matters right now. More people than ever are investing. Apps made it easy. Information is everywhere. Everyone wants a piece of the market. But most people don't actually understand what the market is. They think it's a chaotic place, a casino, a battlefield of winners and losers. In reality, it's heavily concentrated, structured, and in many ways predictable, and at the center of it is this one index. So what is the S&P 500 really? At its core, it's just a collection of 500 of the largest publicly traded companies in the United States. Not random companies. These are giants. Businesses that dominate industries. Companies that shape how we live, spend, and think. If you've ever used a smartphone, streamed a show, bought something online, driven a car, or taken medication, you've interacted with this list. But here's the part most people miss. The S&P 500 is not equally weighted. Every company doesn't matter the same. Instead, it's weighted by size. The bigger the company, the more influence it has on the index, which means a handful of massive companies quietly control a large portion of the outcome. So when people say, the market is up, what they often mean is, a few very large companies are doing well. Let's break that down. Imagine 500 people pulling a rope. In theory, it's a group effort. But in reality, 10 of them are bodybuilders, and the rest are average. Who's really moving the rope? That's the S&P 500. It looks diversified, but it's not evenly balanced. Now here's where things get interesting. You don't actually buy the S&P 500 directly. You buy funds that track it. These are called index funds, or ETFs. Their job is simple. Copy the index. Match its performance. Do nothing fancy. No stock picking. No timing the market. Just follow. And this simplicity is exactly why they've exploded in popularity. Because when you remove human decision-making, something surprising happens. Performance improves. There's an irony here. For decades, investors believed skill was everything. Pick the right stocks. Time the right moments. Outsmart everyone else. But over time, the data told a different story. Most active investors, people trying to beat the market, failed to do so consistently. Not occasionally, consistently. Year after year, after fees, after mistakes, after emotional decisions. And suddenly, doing less started to look smarter. So people shifted. Instead of trying to win the game, they started buying the scoreboard. That scoreboard is the S&P 500. But let's not pretend it's perfect, because there's something quietly uncomfortable about how this system works. When money flows into index funds, it doesn't ask questions. It doesn't evaluate whether a company is overvalued. It doesn't care if growth is slowing. It just buys, proportionally. Which means the biggest companies get the most money, and as they get more money, their stock prices rise. And as their prices rise, they become an even larger part of the index, which attracts even more money. It's a loop, a self-reinforcing cycle. Now pause for a second. That sounds efficient, but also a little dangerous, because it means capital is not always flowing based on fundamentals, it's flowing based on size, and size can be influenced by hype. This creates a strange dynamic. The winners keep getting bigger, not always because they're improving, but because they're already big. And the rest? They matter less and less. So why do most investors still use the S&P 500? Because despite all of this, it works. Historically, the index has delivered strong long-term returns. Not every year. Sometimes it crashes. Sometimes it stagnates. But over decades, it trends upward. And for most people, that's enough. Because the alternative, trying to outsmart the system, is statistically worse. There's also something psychological going on. The S&P 500 removes decision fatigue. You don't have to guess which company will win. You don't have to react to every news headline. You don't have to be right every time. You just have to stay in the system, and that's harder than it sounds. Because the real challenge isn't picking stocks. It's staying invested when things get uncomfortable. Think about it. When markets drop 20%, 30%, even 50%, it doesn't feel like a long-term investment. It feels like loss, fear, doubt. And this is where most people fail, not because they chose the wrong index, but because they couldn't sit still. So the S&P 500 becomes more than an investment. It becomes a test of behavior. Can you trust a system you don't control? Can you hold through uncertainty? Can you ignore the noise? Now let's zoom out. Because the S&P 500 isn't just a tool for investors. It's a reflection of the economy. Or at least, part of it. It represents large, successful, publicly traded companies, but it leaves out small businesses, private companies, entire segments of the economy. So when the index is booming, it doesn't necessarily mean everyone is thriving. It means the biggest players are doing well. And sometimes, that gap matters. There's also a global angle. Even though it's a U.S. index, the S&P 500 is influenced by the entire world. Supply chains, interest rates, geopolitics, technology shifts, all of it feeds into these companies. Which means when you invest in the S&P 500, you're not just betting on America. You're betting on a global system of growth. And that brings us to the real question. If everyone is using the same index, if the same companies dominate, if the same flows keep reinforcing the same winners, what happens next? Does the system become more stable or more fragile? Because concentration can create strength, but it can also create risk. So here's the thought to leave you with. The S&P 500 looks simple, almost boring, just 500 companies, just an index. But beneath that simplicity is a powerful machine, one that quietly shapes where money goes, which companies rise, and how wealth grows over time. And most people are inside that machine, without ever really seeing it. The question isn't whether it works. It clearly does. The question is, what happens when something this widely trusted is forced to change? Because change does come. It always does. Think back to every dominant company you can remember. At one point, they felt untouchable, permanent, too big to fail. And then, something shifted. Technology moved. Consumer behavior changed. New competitors appeared. And slowly, sometimes quietly, they faded out of relevance. The S&P 500 reflects that, but only after the fact. It doesn't predict the future. It reacts to it. Companies get added. Companies get removed. The list evolves. But here's the catch. It evolves slowly, which means at any given moment, the index is a snapshot of what has already worked, not necessarily what will. You're buying yesterday's winners, hoping they remain tomorrow's. And to be fair, many of them do. The largest companies often have advantages that are hard to break: scale, data, brand power, global reach. They don't just compete, they dominate, but dominance has a shelf life, even if it's longer than most people expect. So now you're left with a quiet tension. On one side, history says the S&P 500 works. On the other, logic says no system stays dominant forever. And yet, money keeps flowing in. Every paycheck contribution, every retirement account, every automated investment, more capital enters the same system, day after day, without hesitation, without analysis, without asking, is this still the best place for it? Ho. Because at some point the strategy stopped being questioned, it became default. Ho. And defaults are powerful. They remove friction. They remove doubt. But they also remove scrutiny. Ho. Now imagine a future where something breaks that pattern. Not a crash, not a recession, but a shift, a structural change. Maybe new regulations, maybe a technological leap, maybe an entirely new way to allocate capital, something that makes the current system less efficient, less dominant. If that happens, the adjustment won't be instant. Because trillions of dollars don't move quickly. They hesitate, they lag, they resist change. Which means the system could keep reinforcing itself even as cracks begin to form. And that's the paradox. The very thing that makes the S&P 500 powerful, its simplicity, its scale, its passive nature, could also make it slow to adapt. Hick. So where does that leave you? Not with a clear answer, but with a clearer lens. Hick. The S&P 500 isn't magic. It's not guaranteed. It's not the best in every possible future. It's simply the most efficient solution we've found so far for a very specific problem. How do you invest in growth without trying to predict it? And for now, that solution holds. But systems like this don't announce when they're about to change. They just do. Quietly at first, then all at once. So the next time someone says, just invest in the S&P 500, it's worth remembering what they really mean. They're saying, trust the system, trust the past, trust that the biggest winners will keep winning. Maybe they will, maybe they won't. But the more important question is this. If everyone is following the same strategy, at what point does it stop being a strategy and start becoming a risk no one is paying attention to?